What if I told you that $1 million property today could be worth maybe $8 million in 30 years' time? Sounds unbelievable, right? It's the kind of projection that makes people question whether Australia's property markets can really keep growing the same way they have over the last 45 years. After all, with housing affordability consistently in the headlines and talk of property bubbles, isn't 7% annual growth, meaning properties double every 10 years, isn't it really a thing of the past? Well, today I'm joined by Stuart Wemyss, respected financial advisor and author and director of Pro Solution Private Clients, and he's written an excellent blog unpacking that very topic. Can annual property growth persist at 7%? It's a question I've been getting from a lot of clients, and the answer isn't a simple yes or no. So today, Stuart and I are going to explore what really drives property prices, whether growth at the rate that's had up to now is sustainable, and most importantly, what it means to you as a property investor in today's market. So, welcome to another episode of the Michael Yardney podcast, where I help you cut through the clutter of the many mixed messages surrounding our housing markets so you can safely develop financial freedom. So whether you're just starting out in the property world or looking to fine-tune your portfolio, you're going to get lots of practical insights from my conversation with Stuart. So let's get into it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Stuart, welcome back to the podcast.
Well, thanks for having me back, Michael. I always enjoy our discussions.
Well, so do I. Now, I know people talk about property values doubling every 10 years, which works out to about 7% annual growth. I also know there's a lot of talk at the moment about affordability, interest rates, international comparisons. Many are asking, can it really continue? Well, you recently wrote a blog about this, and I love getting your blogs every Wednesday and listening to your Investopoly podcast. And you delved into that in detail. So I'd like to break that down a bit. In your article, you explained how property values have grown at about 7% for the last 45 years or so. So does a 7% growth surprise? Do you think it surprises people?
Yeah. Look, I think so, Michael. It's a pretty significant headline number. And if you think about, wow, property doubling in value, and you're right, 7.2%. doubles in value every 10 years on average. And, if you sort of think back, well, that makes property really unaffordable for most after just a couple of times of doubling. It's a really big number. And, there's always these international comparisons between, Australia and other parts of the world, could be the US or Western Europe, UK and so forth, which haven't experienced the same level of growth. But I think it's a really important thing to acknowledge, because we have to get our head around that number and ask ourselves, can all property increase by 7% or whatever? Over the last 40 years, the median change in price across the top 5 capital cities, just at slightly over 7% up to March 25. So that's what it's done over 40 years. But over 10, 20 and 30 years, it's grown at a slower rate than that. The other thing too, Michael, is that we have to think about property growth net of inflation, because obviously inflation in a rising tide, all ships rise as well. And we've got to put it in that context. So over the 40 years, as I said, property median prices 7%, but over that 40 years, inflation's been 3%. So inflation's been relatively high over that period as well.
So people don't get the power of that, because when I bought my first property and it was $18,000 and I got $12 a week rent, the average family car was the Holden Kingswood and it was $2,000. And so I got in at a good time, I guess, when inflation was very high. The Labor government had just come in. And so there's the artificial escalation because of inflation. It also has another effect, Stuart. It actually lowers the cost, the amount that your mortgage is worth over time. So your value goes up, and your expenses, if you've got an interest-only loan, the $500,000 loan you got today wouldn't buy $500,000 in 10 years' time.
Yeah, that's right. And in the blog that I wrote, I answered the question. Someone put to me the question to say, well, if I go and buy $1 million property today and it doubles in value every 10 years. In 30 years' time, it's going to be worth $8 million. How can that be? So 1 million after one decade, it's 2, 4, and then 8, of course. And it's a big number. And the difficult thing is, as human beings, we find it really difficult to get our head around these exponentially compounding numbers. I mean, that's the first thing to acknowledge, because the brain thinks in linear terms rather than exponential terms. But if you strip out inflation, let's say 3% for inflation out of that number, it's really the property increasing not from 1 million to 8, but 1 million to 3.3. So I think the inflation element in property prices cannot be underestimated. Now, of course, we've got to beat inflation as investors, because inflation is really just a measure of purchasing power. And so if we're not beating inflation, we're going backwards. So I'm not saying we should just ignore it, but of course, we've got to try and achieve that benchmark of some level of growth plus inflation. That might have been 3 or 4%. That might be 3 or 4% plus inflation. But, if we strip out inflation, it starts to help the brain, I think, get around these numbers, these exponential numbers.
But some people are going to say, Stuart, there's got to be more purchasers with money, with purchasing power, to be able to earn more than the 3% inflation, more than the wages growth. I guess it does mean that in the future, some people are not going to be able to afford a home. Now, there's lots of stories about how long it takes to save the deposit for a median price home. I know I annoy people when I suggest that first home buyers shouldn't expect to be able to afford a median price home for their first home. They shouldn't be able to expect the sort of property it took their parents 20, 30 years to be able to afford, Stuart.
Yeah, look, we've got to adjust what we think is reasonable. Property is often requires a couple of steps to get to our forever home. Whilst that might not have been true, many decades ago, it certainly is true today. So, and it does require sacrifice. I guess that's the thing that was always the case. When I bought my first property, when you bought your first property.
Yeah.
Michael, of course, the numbers are different, but it still required sacrifice. We didn't go on holidays. We saved money. We tried to save as much as possible and spend as little. All those sorts of things are still necessary ingredients to get on into the property market today. But it's a good point. And I think this is what I'd like listeners to really reflect on. It's great to look at that headline number, 7%, but we need to really think about, is all property going to grow at 7%? Remember, we're just talking about median prices too. The median price is not a comparison of like for like. It's really just the middle of the data set. So it's one of the better measures we have of the general health of the market and the general trajectory of the market, but we're not comparing apples with apples. So of course, in a median value, there's going to be half of the property sold for greater than that value and half of the property sold for less than that value. Doesn't really then tell us the distribution of that growth. Which properties, did every property grow at 7%? Unlikely. So which properties grew faster than that and which properties grew slower than that? And I think, if you have a look at the last 30 or 40 years over that time, banking deregulation and the resultant increase in borrowing capacity drove a lot of that increase. It had to drive a lot of that increase because we know that there's a strong correlation between money flows and property growth. That is, when people are borrowing more and more money and putting it into the property market, of course, logic tells us that stimulates property prices. Now, if we assume that borrowing capacity won't grow, maybe just won't grow, I could almost leave it there, or at least not at the same rate as the previous decades, then we have to ask ourselves, what then will stimulate that property price growth? And, when you look at numbers over 40, 10, 20, 30 and 40 years, you can start to see a little bit of that reflect in the numbers. The median growth over the last 20 years has been somewhere between 4 and 5.5%, depending on which capital cities that you look at. Probably 4 to 6% is a better range, which is less than over that 40-year period. So perhaps what the market's already telling us is that the average price growth is lessening off. That's probably a product of borrowing capacity or tighter borrowing capacity. And so really other element to capacity is really investing in locations where either there's alternative sources of wealth to drive property prices higher, or where the income growth of a certain cohort is much faster than the average.
So what I'm hearing you say is, when you ask whether property values can grow at 7% annually in the future, you really got to define the type of property and I guess the location that you're saying. And you were suggesting, reading between the lines, that some households are still going to be able to afford that. And I guess in your article that I'll leave a link in the show notes, that you stated the Australian Bureau of Statistics showed that the top 20% of households earn about half the national income, 47.8% of the gross income, which is an interesting statistic. In other words, some people still have a lot of equity in their home and have got higher wages growth, and they're more likely to be able to afford to push up property values because they can.
Yeah, that's right. And also, if you look at property price growth, if you divide it in 20% quintiles, the top 20% of earners had 40% higher growth rate. So not only do they have more income, but their higher income is growing at a faster rate as well. And I guess mathematically, we can't have sustainable price growth that exceeds income growth unless there's other contributions to in terms of wealth, which I'm sure we'll talk about in a second. So I think the best thing to think about as an investor is you've got to think about return and risk. So there's a return target. Yes, I want 7% growth. That would do really well because my property is going to double on average every 10 years. But the risk element is, what is the likelihood or what is the probability of doing that? And putting that differently is, what locations and type of property have the highest probability of delivering that growth? There's no guarantees, but you want the highest probability. And I think that's what we really need to think about and reflect upon, particularly as, if you think about the last 5 years, Michael, regional locations have done really well. They did really
Yes.
well through COVID. And so when you look at, just the short-term data of the last 2 or 3, 4, 5 years, you go, well, regional areas actually do quite well compared to capital cities. Will that persist? Because it can only persist if the income growth and the amount of income in those locations is going to grow at a much faster rate than capital cities, which I think is unlikely.
Which is unlikely to happen because they don't have, in general, the depth of economic drivers or different industries there. Now, over the last 5 years, there were different factors. Clearly, COVID meant that people tried to escape the cities. And then more recently, I've seen a whole swag of new, young, maybe inexperienced buyers agents herd all their clients into the same regional towns using AI in some ways, looking at data without having perspective of what's on the ground, pushing values in some of these regional areas beyond the underlying fundamentals, and the locals are wondering what's going on, how prices have driven up so much.
Yeah, and look, this is the thing that I like to reflect on in this exercise, is this long-term data. Because the great thing with other types of assets like ETFs or share investments and so forth is typically we're presented with a whole range of returns data, 1, 3, 5, 7, 10 years, something typically along that. And then from inception, which is good because I can then think about, okay, what are the short-term returns have been like, but how's it done over 10 years? Whereas most of the commentary in the media and around property circles is, what's happened over the last 2 or 3 years, what will happen over the next 2 or 3 years. But I think it's much, much better to reflect back over multi-decade periods. And to me, it makes sense because if I'm investing in property, which is a multi-decade exercise, hopefully to benefit from the compounding capital growth, then it makes sense that my reflection period should be much longer, which is not saying ignore the short-term returns, because I think that's important too. It puts it in context with the regional discussion, but really it's about having the highest average return over a multi-decade period, not the highest return over the next 5 years.
Now, I often put charts on social media, and one of the ones that always gets the most comments and gets the most views is when we compare affordability in Australia to other countries, and Sydney in particular, but Sydney, Melbourne, all our capital cities are seen as the most unaffordable parts of the world to live in. And that would get some people arguing that property prices in Australia are overvalued. What would you, especially compared to international properties, what would you say to that?
We've got to think about the geography and infrastructure and the number of taxpayers we have. Because what we need to do for property price growth to be more uniform, it's got to be just as attractive to live in a regional location as it is in a capital city location. Now, it doesn't have to be equally attractive, but it's got to be comparably attractive. So my job opportunities, my proximity to other amenities like restaurants or whatever pastime activities that I'm doing, all those sorts of things need to be really similar. The problem with Australia is that we've got very few taxpayers and we've got too much land. So we can't really build infrastructure. Well, actually, I probably can leave it there. We can't really build infrastructure, but we can't build
Yes.
infrastructure cost effectively and time effectively enough to make it just as good to live in Newcastle or Geelong as it is to live in Sydney and Melbourne. And that's the problem, is we've got half of the population want to live in Melbourne, Sydney or Brisbane. That makes up less than 0.5% of the land value. So we're all trying to really pack in tight here because that's where all the job opportunities are. That's where all the good schools are. That's where all the amenities are, all those sorts of things. And if we live on the fringes of those cities, 30 or 40 kilometres away from the CBD, our travel time is a nightmare. We'll probably spend 3 or 4 hours a day traveling. Whereas if we live in the regions, that could work for some people, but not for most people. Again, larger travel time, less job opportunities. Whereas if you compare, say, Western Europe, whether you lived in Paris or Lyon, I think, is the second most populated city in France, which is only an hour or so train ride from Paris. Your job opportunities and so forth are very similar. You've got much more density, more taxpayers to be able to pay for that infrastructure. It's all going to work. Australia's got too big a problem. It's never going to bridge that gap. I can't ever foresee that living outside of a capital city is going to be just as good or even close to.
Well, other than the Gold Coast, we haven't built a new city for 150 years, have we?
No, we haven't. And we're just not going to have the appetite to do that. You can imagine how much it would cost taxpayers to do something like that. So we've got to be cognizant of that in our comparisons when we're comparing international markets, which is, again, not to say that all property can continue to increase in value at 7%. I think that's the key message, is not all property will do that over the next 20 or 30 years. But some property will.
And in our regular chats, we always talk about not just investment grade properties, but investment grade locations. So we're looking for locations where people are wanting to and can afford to pay extra. And as we said, that's a particular cohort. And in general, they're also gentrifying areas. And it's going to be a long time before the outer suburbs gentrify, but younger people are moving to it used to be the inner suburbs. Now it's more the middle ring suburbs of our capital cities as well. And that's only going to create more scarcity. So back to the question of, can we really expect long-term capital growth at the same sort of levels? What about interest rates? How do you see that affecting our housing markets?
I think we're going to start thinking about capital flows. So where is the money going to come into the property market and where will most of that money land? And so I think we've talked about borrowing capacity because that was kind of a universal thing that changed over the last 40 years, but it's not going to be universal anymore.
So just to remind people that borrowing capacity increased, first of all, because banks allowed spouses, husbands and wives' income to be included. And then the lending criteria changed in the 90s. There were new lenders came in with the building societies and Aussie John. And so even though some people are finding it hard to borrow at the moment, and there's no doubt that that's occurring, there are all these incentives as well, 5% deposits for first home buyers, banks allowing certain sorts of people not to have lenders' mortgage insurance. So the lending criteria changed and became easier for some over the last couple of decades. Can't see it changing much more. How much more incentives for new home buyers can the governments give us? How much lower can interest rates go?
And the big one, Michael, was a big change was really sort of early mid-80s. It was typical to borrow 2 to 3 times income.
Yes.
Whereas now it's not unusual to borrow 5 to 6 times income.
Maybe the other one could be longer mortgages, longer term
mortgages. Yep. Yeah. I mean, I think that's inevitable. Doesn't really change borrowing capacity that much. So from 30 to 35 years, maybe from 30 to 40 years, it's all going to have an impact, but it's not going to be the same impact as changing borrowing 3 times income to 6 times. Obviously, that's a doubling of borrowing capacity over a relatively short period of time. So I sat back and thought about, what are all the things the positive things that are going to influence the property market? And so we can talk about them. And then the other thing we need to think about is which sectors of the market are they likely to flow into. So the first one was lower interest rates. Of course, we've just gone through a period of much higher interest rates and they're set at contractionary settings at the moment. But obviously, the market's talking about interest rate reductions, and we'll probably see a few reductions this year to a more normalized or neutral level. But as property investors, we're going to go through periods of time where interest rates are below average, when they're at average levels, and when they're above average. But we know that when interest rates are lower, it tends to stimulate property price growth.
Sure. Okay. There's also the transfer of money. There's different amounts suggested. I've heard between 3.5 and even up to $6 trillion of wealth transfer as the baby boomers die off. And it was initially suggested that's going to happen as the baby boomers die off. But nowadays, the bank of mum and dad has become more important, and lots of people, they're worried are there going to be death taxes. They're already starting to pass on funds to their children and grandchildren. That's going to help a segment of the market to be able to keep buying and pushing up property values.
100%. Look, we know from our work with clients, when they receive an inheritance, a reasonable proportion of the time it was result in them upgrading the home. They might have already planned to upgrade, but they'll sort of bring it forward. So while some of that money might already be invested in the property market, so if baby boomers pass away and their family home is bequeathed to their beneficiaries, of course, some of that's already in the property market, but some of it's not, right? Some of it's in superannuation. And even the Div 296, the new tax that is applied to anyone that has more than $3 million in super, not law yet, but the proposed law,
Yes.
it's going to exacerbate it as well. The government's quoted that they're going to raise several billions of dollars through this tax, but I can guarantee that's not going to be the case. And I know already some clients have received early inheritances from their parents that are going to be liable for that tax, so that they've got too much money inside super. So there's a very large sort of inheritance tsunami that's coming this way now. People tend to do really smart things with inheritances. The general concern for a lot of people is, well, if I leave this money, are they going to waste it? In my experience, clients tend to think very deeply about how best to use those monies, inherited monies. So they're either going to be invested wisely or they're going to upgrade their home. It's probably one of those two things. And so a lot of that money is going to end back up into the property market. Maybe not in the big family home, but if clients already have that, maybe it's an investment style property. And now, as I said, I think that proposed tax for super balances greater than $3 million will exacerbate bring forward inheritances as well. So some of those projections will be undercooked, because they're probably thinking, well, the inheritance won't occur until the person passes away, but it's more likely to happen earlier now.
Now, in your article, you suggested there'd be another couple of reasons why money is going to go into property. You were suggesting employee share schemes now become a bigger factor, and also the alternatives. Where will Australians invest their money? And you suggested that maybe equity returns won't be as strong and as good an alternative moving forward, Stuart.
The US market has had a tremendous run over the last 13 years. And I'm not one of those people that want to turn this into a property versus shares debate. But we do know that capital tends to flow to markets that exhibit better opportunities for future returns. And so when there's greater volatility in the share market, we tend to see more money flow into property markets. And when returns are below average in share markets, that also tends to flow into property markets. So if the share market delivers lower returns over the next period of time, yes, I think property by comparison will look like an attractive investment again. And the employee share scheme thing, Michael, is something that I've really noticed substantially over the last, particularly 5 years. It can really change a person's financial position, and it can be a little bit of a windfall too. So you join a company, you get a sign-on bonus, or they have a good year and they give you some additional shares. Because of the taxation arrangements, because people tend to be taxed on these shares in the year that they become vested, is the word I was looking for. People tend to have to sell the shares to pay for the tax. And they tend to sell the shares also because they don't want such a concentration risk. And so what I find is these share schemes tend to end up in the property market as well, either through loan repayments, aggressive loan repayments,
Yep.
or additional borrowing capacity and purchasing capacity. And it can't be underplayed. I think it's very hard to measure, what impact has it had, but I think it's going to have and has had a substantial impact on some markets.
Now, there's another factor that's going to create maybe a more short-term effect pushing up property values, but the first home buyer incentives are going to be coming into place. Well, a whole lot of new ones are going to come into place in the beginning of January next year, making it easier for first home buyers, particularly in the sub $1 million category. In Sydney, it's $1.5 million. And that's going to add more competition at the entry level. The story, of course, from the Labor Party before the election was we're giving an incentive to get people into the housing market. Having said that, though, it's just going to push prices up because if people have more money, we know that they're going to spend it, and it's going to make it harder for the next generation.
Yeah, I mean the government guarantee where if you've got 5% deposit, the government will guarantee the remaining 15%. I think is a really good scheme in that it will bring forward more people or make property more affordable to more people to be able to get into the market, because typically it's deposit that's limiting factor, not necessarily on serviceability from a borrowing capacity. So I think it's a quite a good policy, but it certainly is inflationary to prices, and particularly in that price point. And we saw that. We have to cast our mind back to '07. I think it was the Rudd government doubled the first homeowners incentive, and we saw that just flowed straight through to property prices. So we know these things certainly stimulate prices, and that might be a little bit of a short-term sugar hit from the beginning of next year, particularly for that sub $1 million market.
So I guess we started off talking about, Stuart, can property values keep doubling every 10 years? In other words, property values grow at around 7% per annum. And the simple answer is maybe. Some will, some won't. But I think if we believe that Australia's population is going to keep growing, and Australia's got a business plan of having 40 million people by the middle of this century, both sides of politics have got a similar plan. And if we believe we're going to remain a wealthy nation because you need that, then it's very likely that property values are going to keep increasing. But not all properties. And in previous discussions, we've discussed where or what. So there isn't one property market. Stuart, a couple of times through the discussion, you talked about my clients, our clients. Maybe you could explain who your clients are, Pro Solution Private Clients, and what you can actually do to help them with property.
Yeah, sure, Michael. We work with clients on a holistic basis. We develop a long-term plan and then work with them over many years to implement that plan. And the holistic basis means that we know that many financial decisions are multifaceted. They have taxation considerations, borrowing considerations, financial planning. And so we bring the whole team in one room, discuss that one client, and make sure we explore all risks and opportunities to help that client achieve their maximum outcomes. So that's what we do at Pro Solution, and we love what we do.
Well, I'll leave a link in the show notes to that, and of course to your blog. So for people who've listened so far and are thinking, well, they spoke a lot. Can property values keep increasing at these sort of levels? What's your bottom line for them?
I think the best question to ask is which properties in which locations have the highest probability of achieving the highest growth rate? And the answer to that question is the locations that attract the wealthiest 20% of people, because the wealthiest 20% of people we know have higher incomes, higher income growth, and also access to alternative sources of wealth. Because if
They
I'm
have
going
multiple streams of income, don't they?
multiple streams of income and, as I said, alternate sources of wealth. It could be employee shares, it could be inheritance, it could be business sales, all these sorts of things. Conversely, the alternate thing to think about is if I'm going to invest in a particular location, so if you identify this location that you think is going to be so great, what is going to drive property prices in that location? Are there alternative sources of wealth? What is the demographics of that location, and what is their historic income growth been? Because we want perpetual growth. As investors, we want perpetual growth. If I'm investing for 30 years, I want the highest average growth over that 30-year period. And in some locations, or some people want to invest in locations, I look at it and go, I just can't understand how the people in that location are going to perpetually drive property prices higher. And that's true. What tends to happen is they tend to drive the property price to the median, And then once it's hit that median, it'll level out. And then that growth will just have that ripple effect onto the next land release or whatever it might be. Now, that's great for the investors that get in early, perfectly timed, have 5 years of fantastic growth, and then they're left with an asset that does very little for the next 15, 20, 25 years. That's not the answer to building wealth with property.
I agree with that. Of course, we've got to remind people that we're not suggesting that properties, even those better investment grade properties, are going to keep increasing year on year. We know that every market has periods of years when they're flat. Just think of Perth for a decade before it's had this great growth spurt. Think of Melbourne for the last 5 years, apartments and houses. And now over the last couple of months, the Melbourne market has picked up, and most forecasters are suggesting it'll be the strongest market over the next couple of years. So you've also got to be able to afford to hold the property, and smart property investors buy themselves time by having financial buffers in place, not just properties. Stuart, always love having a chat with you and unpacking these smart ideas you've come up with. As I said, I'll leave a link to the show notes and in the show notes to your original article, and look forward to catching up with you again next month.
Thanks, Michael. Been fun as always.
If you're a regular viewer or listener to the show, you know that each week I have a property trivia question, and giving you the opportunity, my listeners and viewers, to win a hard copy of one of my best-selling books. At the moment, I'm giving away Michael Yardney's Guide to Investing Successfully. Just go to propertytrivia.com.au. I'll leave a link in the show notes and leave your answer to the question I'm about to ask. And each week, 3 correct answers win a hard copy of my book. Don't worry if you're listening to a slightly older episode, your entry will still count. And everyone who enters gets a copy of an updated property report I've just written. So here's this week's question. Which material was famously used to build the roof shells of the Sydney Opera House? We know they're white. What material did they use on the roof shell, those shells of the Sydney Opera House? Go to propertytrivia.com.au, leave us your answer, and good luck with the competition. We just had a chat with Stuart explaining where property values are going to be, and we believe in 10 years' time property values will double again. So imagine yourself in 2035, in 10 years' time from now. What will you have achieved from your property investing in 10 years' time? Will you have achieved the financial independence you're looking for? Will you have built a property cash machine that gives you substantial passive income that gives you more choices in life? Now, what made me ask this question was I was thinking about a couple I spoke to a couple of days ago, Paul and Annette, who are now in their 50s, and they're planning to retire in 10 years' time. And I don't see many clients anymore, but I've been working with them for over 15 years. I really enjoy our annual reviews. And it was fantastic to see this substantial portfolio they've built with investment properties in all 3 capital cities. Running their numbers through our sophisticated planning software showed the passive residual income they're going to have in 10 years is going to give them the financial freedom they're looking for. Some people would say they're lucky. I know they planned to become the people they planned to become, received good advice from the team at Metropole, but more importantly, they acted on it, and now they feel in control of their financial future. So do you know where you're going to be in 10 years' time? They do. Why not go to metropole.com.au and have a complimentary wealth discovery chat with one of our wealth strategists to discuss your options for your financial future. You'll find we're much more than another buyer's agent. We help our clients safely outperform the markets and help them have intergenerational wealth through strategic property and wealth advice. Just go to metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you the concept that the poor love to hate other people's success. I found there are 2 types of people in the world: those who hate the success of others, and those who let the success of others fuel themselves towards getting even better results, having greater success. Most people fall in the first group. It's what we call the tall poppy syndrome, isn't it? So here's my tip for you as part of this mindset message. Be in the second group. That's the way the rich people think, while the poor revel in the failure of others. Some people look at other successes and failures as a way of validating how far they've gone themselves. They pick apart the reasons why certain people achieve success, and they relish the moment when others fail. Now, that's just a path to mediocrity in my mind. It's easy to spot these type of people because they tend to use the word luck It's the ugly truth in life. There's a long list of people who'd rather complain than actually do something about it. As for luck, I've always thought that hard work creates good luck. Take a quick assessment of how you respond to the success of others. Does it discourage you or do you envy them? Now, don't allow yourself to be brought down by those hopeless emotions. Instead, I suggested you should allow other success to fuel your fire to achieve your own levels of greatness. So today, pick out somebody who's doing a great job and compliment them for it. Muster up your sincerest praise and generously pour it on somebody else. The sooner you're able to recognize and praise greatness, the better chance you're going to have of replicating it. And when you succeed, know that some people are going to hate you for it. When you fail, some people are going to cheer. In fact, there's not a successful person out there who isn't in some ways hated for their success. But the truly successful folks are the ones who can build something remarkable when insults are hurled their way. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?